Hello, Mark Lowerty here at IPBC Global 2014 in Amsterdam. Everyone's agreed that there is huge value in intellectual property. But the problem is we don't have a unified way of measuring the IP value, and therefore we don't really know what the value of IP actually is. We can't quantify it for as long as there is no consensus. On the one hand, this creates a great deal of flexibility. But on the other, it is just this flexibility that causes a great deal of problems. Peter Holden is a pioneer in valuing and monetizing patent portfolios. He heads investments at IP Value Management and says there are advantages and disadvantages in systematically valuing IP.
You know, if you're a financial institution, then there's established practices for valuing IP as a debt instrument and for derivatives like that. If you're a large corporation, it's already accounted for on US GAAP if it's acquired, but for organically grown R&D that's been converted as a byproduct into patents, there's pros and cons. If you do value it, then people want to know what the accounting principles for value are, and that's heavily contested right now. There's no generally accepted principles which test the proof of metal in litigation, for example. It's a huge area of controversy. If it's off the balance sheet, companies have tremendous scope for discretion and flexibility in selling non-core patents, in squeezing in licenses before Q2. So it's a tremendously important revenue source that they can call upon as needed to make numbers. Whereas there's going to be much more scrutiny if it's on the balance sheet at a prescriptive, prescribed valuation. So there's pros and cons.
The challenge for companies is how to explain to shareholders the value in spending money on research and development. That would be made easier if companies were able to capitalize intellectual property on their balance sheets. It's a question that was put to the keynote speaker, the president and CEO of Philips, Frans van Houten.
I would find it very complicated to see IP on the balance sheet, and I'm not sure that that would be favorable to the community. It's very hard for the same discussion we just had and all the years that it is out to value IP on the right basis. And then you would get maybe adjustments from year to year, and that would influence your P&L, and it would destroy shareholder confidence. So I find this I think this would be very, very tough to do. So I'm not very enthusiastic about it, as you can see.
Thomson Reuters is well known as a financial data provider, but it also markets IP solutions. They found another way to create a link between the value of intellectual property and operating performance.
We've launched something that we call the Top 100 Global Innovators. And while it's meant to recognize some of the most innovative companies in the world, my original vision behind that award was to actually facilitate an ongoing basis of being able to correlate financial success with that rate of innovation. And over the last 3 years since the award's inception, we've seen a direct correlation between winners and their investment in R&D, which is higher than their peer groups in the S&P 500. We've seen sales revenue correlation above peer groups, but also increased hiring. And while correlation is not causation, it certainly is a sign, anecdotal as it may be seen, that innovation is driving commercial success. And it's not a surprise to me that every government in the world, every corporation in the world are focusing on innovation as a way to create sustainable advantage.
Peter Holden cautions that IP valuations could be used to manipulate corporate earnings. But he says, despite the challenges, the industry has to find a way to capitalize intellectual property on corporate balance sheets.
I think so. Several reasons. One is we're in a knowledge economy and IP is the currency. So to properly value companies in this marketplace, you have to recognize a huge part of their total net worth is in the underlying R&D as manifested, not just in products and services, but also in the quality of their intellectual property. And if you look at any high margin business, the top of the food chain is the IP and the people, and everything tears down from there. So the benefits of capitalizing it are lower cost debt, the increased IR, PR benefits of people truly appreciating the underlying value of their assets and they're being capitalized as such on the balance sheet. And as long as the accounting and the investment services understand how these assets are valued and can get to consensus in the pricing methodologies used, I think it's an inevitability. And if the US doesn't lead the way, I think we'll find other economies in the vanguard of driving these processes.
Such as Japan, which you're familiar with? Or?
Japan or China, but some of the kind of gateways like Hong Kong or hinterlands like Singapore that are trying to establish themselves as an IP hub, where they're offering tax-free benefits, Ireland as another. So it would be a natural extension to offer accounting processes to companies that become domiciled in these territories to put the value of the assets on the balance sheet, which would significantly improve the market cap potentially if you get consensus by Wall Street and the city that this is indeed a valid and legitimate thing to do. And that remains to be seen.
Mark Laudy for IPBC Global 2014 in Amsterdam.